My name is Jan Gonzales. I am, if I haven't met you before, Community Education Supervisor with the UC Cooperative Extension Office in San Diego. I work with my colleagues, Darlene Ruiz and Ramiro Lobo. I'm our Small Farms Advisor on agritourism issues and small farm issues. We have a very small crowd today. I'm not quite clear as to why. Hopefully we'll have more joining in as the minutes tick by. And we're going to change the lineup a little bit. This is part of our webinar series on delving into specific topics and considerations with your agritourism or farm business planning. And so today is about tax and legal checkups, anything that you should, we recommend that you maybe review occasionally with your business planning and consider different topics. So one of our presenters is not with us yet. So we'll go ahead and change things up a little bit. We have an hour set aside for this session. We're saving questions towards the end of the hour. And we are recording this for later posting, so you can refer back to these presentations later on. If you have any questions, please enter them in the chat, the Q&A, or raise your hand, and we'll take note of it. But we'll probably just field. I mean, we're a smaller crowd today, so I'm not quite. We'll see how the timing goes. But yeah, please don't hesitate to post your questions as they come up. All right. So without any further delay, I'd like to introduce you to Jeff Tranel. I'm not sure if I'm saying Tranel. He is an agriculture and business management economist with Colorado State University. We're very pleased to have him join us, and he'll talk to us a little bit about some legal reviews and updates. Okay, Jeff.
Okay, thanks, Jan. Let's do that. I think that came through okay.
Yep, that looks great.
Okay, good. Ooh, it got quiet there. I thought maybe I lost you. It's like, oh no.
I muted too quickly. Okay, now I'm gonna mute.
Okay, sounds good. Well, thanks everyone, and good morning, good afternoon, depending on where you are. It's after lunch for me here in Colorado. As Jan said, I'm an agricultural and business management economist with Colorado State University. I have an extension appointment, and I'm affiliated with the on-campus Department of Agricultural and Resource Economics. I want to talk with you today about two important points on legal entities and leases. Narrowed it down, only supposed to have about 30 minutes. Both of these topics, I can take a full day to provide information, etc. on those. So we're going to lay out a few things, kind of overarching. I want to drive home a very important point. It is critical for you to seek professional counsel from your accountant, attorney, other applicable professional before you make a decision or take action. Before is the key word. Once you make a decision, you sign off on an agreement, whatever the case may be, those impacts are mostly fixed. We know what's going to happen. And the changes to that can be, if they're possible, can be complex, they could be time consuming, and they may be expensive in the normal day of operations, or they can be expensive as you deal with your accountant, attorney, or others to get this to happen. So let's first talk about some of the more common organizational structures as they impact both the operation, taxes, liability, estate and succession planning, and many other aspects of owning and operating an agricultural business. before you decide which structure is best for you, again, talk with your attorney, but also determine your risk preferences and set both ownership and management goals, because they all impact every aspect of this. So there's really three types of structures, and then there's breakdowns from each of these. Sole proprietorships are still the number one. 86% of organizations are sole proprietorships, according to the Small Business Administration, whereas partnerships and corporations each account for 7%. So it's rather significant in what happens here. And you can see here's another chart of a little bit more. The bottom number there shows the non-employers, and then the small employer firms there at the top. So let's start delving into the sole proprietorship a little bit, just real quickly. It's not a legal entity. It simply refers to a person who owns the business and is personally responsible for its debts. It can operate under the owner's name, or it can do business under a fictitious name. Maybe I have a small business and I operate under, Blue Sky Enterprises. States will vary on how they regulate this. And also, with some states have requirements that you register or certify a trade name or doing business as. That will vary, again, by state. So I want to look at 6 aspects of not only the sole proprietorship, but the others as well. And these are formation, operation, liability, taxes, transfer, and dissolution. So let's start with the formation. One of the great features of a sole proprietorship is the simplicity. I mean, you simply start buying and selling goods. There's no formal event required to form a sole proprietorship. And generally, there are no formal annual filing fee requirements. You just do business as. Again, as I said earlier, some states will require a business, if it's doing business as or DBA, that must be renewed annually. Again, it depends on the state and local government, but that requirement is, if you're doing business as, simply protects that name. As I said earlier, the owner of a sole proprietorship typically signs contracts in his or her name, and customers make payments to that person. We commingle personal and business property and funds. What's mine is mine, whether it's a farm business, it's an investment in town, it is a stock, bonds, whatever the case may be. And because it's so simple and there's typically no state requirements, there's also no formalities such as voting and meeting associated with the more complex. Maybe it's just husband and wife or couple or whoever it is, family, sit down and talk about things. They may do some voting, but it's not a requirement, nor is it formal and that minutes need to be taken, etc. Also, in the operation, you would need an employer's identification number, an EIN, but usually it is the owner of a sole proprietorship's Social Security number that is used on most tax returns. Liability, because there's no formalness to this, a single person, the owners of a sole proprietorship, are personally liable for all the debts of the business. We take on the debts. If we fail, we're still responsible, depending on, of course, judgments by the courts or anything like that. If we go into taxes, the IRS does not recognize sole proprietorships as having separate tax status, i.e., separate from the individual. It's just an extension of the individual. So my Form 1040 may have a Schedule F with it because I have a farm business, may have multiple Schedule Fs, multiple Schedule Cs, whatever it is, but it would not have its own tax reporting. And again, when it comes to transfer, whether we gift it to someone else, we have it as part of our estate planning, so our heirs would receive it, whatever it is, our farm business operated as a sole proprietorship is simply commingled with all of our other assets and debts when it comes to termination. And to terminate the business, you simply sell it, you gift it away, or you die. I spend a lot of time on estate and succession planning, so the word death does not bother me. I use it quite often. So these are the ways that you would terminate a sole proprietorship. Again, very simple, very easy to go through and operate. So let's now talk about corporations. There are really two types of corporations that we existing for farmers and ranchers, the C Corp and the S Corp, and they're very different. The C Corporation is an entity unto itself, i.e., net income is reported and taxed at that entity level. Any distributions from the business to the shareholders are then subject to computation of income tax liability at the personal level. Converse to this, the S corporation is almost like a partnership in that it is pass-through income. It's an ordinary corporation. There are a limited number of shareholders that can be there, whereas with a C, it is unlimited. And for state law purposes, it's formed just, both of these are formed alike. The one key point here is that the taxation of net profits in a C Corp are taxed at the entity level, and at an S Corp, they're passed through. So again, I want to look at the 6 different features of these with you. Formation, they're created when articles are filed with the appropriate state officials. In Colorado, it's a Secretary of State, but there may be other states will have some variations of this. Again, that's when they're created. The articles of incorporation, sometimes called the corporate charter, contain basic information about the corporation, such as, its name, its address, but it does not govern day-to-day operation of the business. Once the corporation is formed, be it a C or an S, the directors get together and authorize enactment of the bylaws, which govern the day-to-day operations of the corporation. So it's a 2-step process here. And management of a corporation under normal circumstances is usually allocated to or granted to a board of directors. Because the level of complexity and formality may not be desirable or necessary in a real small corporation, say it's mom and dad, or Bob and Jim, or Sue and Sally, doesn't matter, multiple people. Some state statutes will allow the small corporations to elect to have shareholders retain management authority. And that authority would need to be granted in the corporation's article of incorporation. So again, because we're talking state statute, every state is slightly different in most of these. Owners of a corporation have limited liability for corporate debts. In other words, a shareholder stands to lose only the value of his or her investment in the corporation. Think of this as you own a share of General Motors stock. You are limited to the loss of the value of that stock. Any debts incurred by the corporation do not get passed down to the shareholders. Again, as I said earlier, the C Corp has net profits taxed at the entity level, and an S Corp, there's no entity level taxation. That income is simply passed through to the individual owner. And then the individual owner would pay income tax and self-employment tax at his or her applicable rates. Absent any agreement to the contrary, a shareholder may sell or otherwise convey shares at any time to anyone else. It's what the stock market is about. So if you have a corporation, think of that. You just need a willing buyer or a transferee, become a shareholder with all the rights that the position entails. There are very few limits on shareholders' right and power to transfer shares. In an S Corp, there may be a few more because of the pass-through entity and the limited number of shareholders. The process of terminating a corporation is typically spelled out in the corporate statutes of any state. You have to follow those rules. They cannot be circumvented by your articles of incorporation or anything else. The state rules are going to follow this. Now, let's take a few minutes and talk about the limited liability company, or an LLC. It is a creature of state statute only. And the LLC is becoming quite common in farming and ranching. In fact, although I'm not an attorney, I work with an attorney or multiple attorneys quite closely. LLC is a very common form of legal structure organization for a business. Now, the IRS does not recognize the LLC as its own taxable entity. The owner of a limited liability, if there's only a single owner, it would be treated like a sole proprietorship. If there's more than one, it would typically be treated like a general partnership. So you would actually fill out Form 1065, the partnership tax returns for an LLC at the federal level. Each state handles LLCs slightly different. Now, a third way for taxation of an LLC is as a C corporation. The owners of an LLC may elect, so you request the IRS to treat, for tax purposes, the LLC as a C corporation. So it's taxed at the legal entity level. Having I personally own multiple LLCs, and I have some taxed at the corporate level and some as partnerships. So you have to be careful here. You have to work closely with your attorney and accountant to figure out which way is going to be best for you. Again, let's look at the 6 factors of each of these. And so we look at the formation of an LLC. It's when the articles and other required documents are filed with the appropriate state officials. Again, in Colorado, it's the Secretary of State. There may be someone different in California. Although some states do not require an LLC to have a company charter nor bylaws, I strongly recommend an LLC have these because they clearly state the agreed upon rules of operation and function. So some states don't require bylaws. They are highly preferred and recommended. The LLC may be managed by either the members, i.e. the owners, or by a manager. Member managed means that all members share responsibility for day-to-day operations and have the power to bind the company to ordinary business contracts. So any member owner can sign contracts. On the other hand, a manager managed structure means the managers have both the actual power to manage and the apparent authority to bind the business by acts which appear to be carrying on ordinary course of business. Now, also the manager may be a member owner or may be a non-member of the LLC. So depending on how you want to have this managed, it's really important. Liability, of course, it's limited. It's in the name. Member owners of an LLC have no personal liability solely based on their status as a member. They will be liable for the amount or value of any agreed upon contributions. So that initial investment, future contributions made, all may be at risk of going away if things got in trouble with that, if there was a lawsuit or some other issue with debts. So, and again, there's always a caveat, provided the member owners do not engage in misconduct. All of these corporations, if you are involved in personal misconduct, you do things illegally, things change rather quickly. Again, as I said, talked about earlier, a single member is taxed as a disregarded entity like a sole proprietorship, whereas 2+ members are taxed. The taxes are treated as a partnership or as a corporation. In most states, the LLC can provide a transfer of an LLC membership interest only to transfer economic rights. And of course, it goes away. You have the right to withdraw. I want to hurry through this. I'm taking a little longer than expected. I'm sorry about that. The general partnership, limited partnerships, and limited liability partnership, they all have their own features. I'm not going to go through the 6 of those real quickly because I want to step into leases. I can share this later on as we need to. And there's interest. If you read quickly, they're there. I do want to say that Right Risk has a number of, has a fact sheet for each of the more common, up to 8 of the organizational structures. And then there's a 2-page front and back chart comparing the different aspects and features of each one, such as the formation, taxation, etc., what I just showed. Real quickly, I do want to share a couple of points. The business structure you select may impact USDA government programs. They may impact estate planning and succession planning. Just make sure they reach your goals, help you to reach your business and personal goals. And it's not uncommon to have multiple of these. Jan, I assume we have a couple more minutes.
Yes, unfortunately, we have not been able to get a hold of our next speaker. We're still trying to reach her, but please, if you have more to share, we welcome hearing from you.
Okay, I'm going to go into leases.
Okay, great.
And
Thank you. Thank
you
you.
bet. And so, and we can go back if people have specific questions about any of the slides I've shown. So farm leases actually provide a producer access to cropland, pasture, animals, equipment, buildings, facilities, any aspect of that that you need. It allows shared risk as opposed to you being at risk to spend all your own capital to do this. And then, of course, many states have adopted provisions, sorry about this, that apply specifically to agricultural leases. So you need to be careful of those and do some checking up on it. There we go. So leases are not merely instruments allowing farmers and ranchers to gain access to certain assets. Holy cows, pause here. Sorry about this. I don't know what, my transitions are off. I missed a couple. But it's a communications tool. I say water. Water in California is just like water in Colorado. Irrigation is expensive and it's quite common to need to do it, to have it. And the only way to get access to it is to lease it. So you can lease it from other farmers, from the ditch company or canal company, others having it, whatever it may be. In some cases, we also lease livestock water, depending on where we are. Landowners also may grant a lease to oil and gas company for development of minerals under their property. Wind companies seek leases for the development of wind energy. Because same with solar, all of this impacts not only the landowner, but also the tenant, because there's an easement there, land will be damaged. It's much easier to not have a wind tower or a set of solar panels to have to farm around. If you can just farm in a straight row, it works easier. So there's some damages that the tenant needs to recall and have in his or her lease. So this is important. We will also have, in some cases, hunting rights, and that lease needs to be very clear in how it states the tenant's use of that land for hunting, whether it be only for he and his family, or if he could sell hunting rights, bring in agritourism, whatever the case may be. Same with recreational use. And it may be the landowner wants to reserve or preserve hunting rights for himself, recreational use for himself, whatever it is. These leases are really important as a communication tool because they lay out so many key factors. Now, to be valid, a farm lease needs to have the extent and boundary of the property. Describe where it is. What property are you talking about? It needs a definite term that the lease will run. Runs from 1 January to 31 December, whatever that looks like. And it needs a definite rental rate, how that is calculated, what it is. So in other words, pretty simple description of the parties involved, the property involved, the rental rate, and the length of or term of that. Here's one that gets rather interesting, is the written versus the oral lease. Oral leases can be valid so long as state statutes are abided by. And these state statutes, I don't even know what they are in Colorado, much less California, because we're encouraging producers to use only written leases. And in some cases, like if you are receiving farm program payments or borrowing money from a bank or other lending institution, they almost always require a written lease. One of the statutes that is common across the states is that a written lease is required if the term of that lease is longer than 1 year, longer than 12 months. And again, the common terms or common provisions is the term, the rent, how it's terminated, any limitations, any requirements and responsibilities. And as we get into the next slide on the different types of farm leases, those responsibilities and who pays for what are really critical. Some leases have a fixed cash rate for which the tenant or lessee pays a fixed dollar amount, regardless of production or other factors. A twist to this is that a flexible cash lease is when the owner and the tenant share some of the risk. There's a base amount that's fixed, and then above that base, the rent is flexed according to yields, input costs, market prices, whatever you choose to have in there. And so in those years when, say, yield is very high, profits would be higher, those profits would be shared. So again, a shared risk. Conversely, if yields are bad. The crop share agreement has been around for a long time, hundreds of years. And it's simply the owner and landowner and tenant each receive a portion of the crop. They may also, in certain cases, share input cost. Livestock leases on pasture can be fixed at such dollars per acre, dollar per day, or they may be flexed. So the IRS treats lease payments very differently than purchase payments. Whoops, there we go. Let me go back here. Rent and lease payments are deducted in the year paid. They go on the Schedule F. Purchase payments are depreciated. Now, those items in that box there are really important. Those 5 items differentiate how a lease is different from a purchase. The key factor is that any lease that does not state or imply that if it does state or imply that the tenant is gaining any ownership of that asset, it is a purchase, not a lease. So you've got to be very clear on this point, these points here. So some resources that I use personally all the time on ag leases, and I encourage producers to use as well. Whoop. Let me go back to that. aglease101.org is fantastic. Every university has, their extension service has fact sheets and other information upon it about ag leases, ag risk library. Ruraltax.org will provide some tax consequences of this, as does the IRS. And of course, your attorney. Please see your attorney. I can't stress enough that you need to consult with your attorney before you sign any agreement or contract. With that, Jan, I want to say thank you. Hopefully Ruby's okay. Oh, she's on.
Yes, thank you, Jeff. Really appreciated
Sorry about
that.
taking so long. It's
No, that's
but
great. It's great. There are a few questions in the Q&A. I don't know if you want to try and address them in writing, or we can wait till the end. Just letting our participants know we may go a little longer today. So hopefully you can stay on for any additional Q&A. But I'd like to now introduce Ruby Ward. Thank you for joining us, Ruby. She is the extension specialist, specializing in agriculture tax, agriculture entrepreneurship, community development. She's with the Utah State University. And again, thank you for joining us today, Ruby. Go
Happy to
ahead.
be here. And so, just so that I kind of keep on your schedule, how long do you want me to go, Jan?
Well, we're scheduled to go to 12 and having some time for Q&A. So,
Okay.
yeah, we
All
know
right.
we might go a little over this time. Yeah.
Okay.
Thank you.
Thanks. So, this is, I put this slide set together with the help of Adam Kantorovich at Clemson University and Sarah Campbell, who is with USDA Farm Service Agency, and with the Beginning Farmer Program and other things. So I thought rather than going through a lot of specifics of tax law, more going into tax planning and record keeping would be beneficial. And so that's what we're going to do here. And I also wanted to give you kind of some resources that you could follow up with. So USDA has partnered with some tax experts to provide and deliver ag tax education materials. And the way that you can get in touch with all of those materials is on farmers.gov/taxes. And that's normally where webinars will be hosted from monthly. And then the recordings of all the webinars are available there. I'm with my group, the website that we run is ruraltax.org, and we link in with farmers.gov/taxes. And so really kind of going to either one of those will get you to the webinars, the recordings, the fact sheets, and all of those. And they're on a variety of topics, and other resources are there available. And then some additional ones at agftap.org. So, and the reason FSA did it is because producers are new to USDA programs. There's some of the new disaster assistance programs but mainly to develop strategies to optimize financial benefits for farmers in the tax code, because there's various things in the tax code. And so this is just kind of the legal or the stuff of kind of who works together with who before we start kind of into the meat of the presentation. So I'm kind of going over it quickly, but just remember farmers.gov/taxes is a great resource. And then, like I said, the website that we run is ruraltax.org. And the webinars and the fact sheets are going to be on both of those websites. So it's hosted here at Utah State University. But the materials are created by the National Farm Income Tax Extension Committee. And there's several members from different land-grant universities across the nation. And Jeff, who was just doing the previous webinar part here, is also a member of this committee. And these are just a few of the topics there, but this is a great resource, so remember this one. And here's the disclaimer, just basically saying the opinions or conclusions are not USDA's opinions and conclusions. We're an equal opportunity employer, Let's go on. Okay, so now we're kind of getting into the actual presentation. And when I talk about taxes, a good thing to remember is that everything that we give in a presentation, whether it's my presentation today or another one, is general. And so with every tax or legal situation, the actual answer may vary based upon some subtle differences in your unique facts and circumstances. And also, there could be further guidance that's published by the IRS or law changes. In fact, we may over this next year get some law changes that affect our taxes and tax code. So remember that the information is good for the day that it's presented. And it's the general information, but really, you really want to consult a legal or tax professional for your unique situation. But this is to give you some good ideas. So what I wanted to go over today is the records and working with a tax professional, tax management. And so just kind of going over some of the things that you ought to think about doing at different times of the year, and then potential tax law changes, just giving you a heads up on that. And we are not going over tax issues unique to Native Americans. I somehow, when I was updating the slide set, missed that little bullet point. So the goal of tax management is to maximize your after-tax income over multiple years. And so it's not to minimize the taxes paid. You could minimize taxes paid if you have a loss every year or have zero income, and that's not going to be a financially sound strategy. And so you're not trying to minimize the tax paid, but you're trying to maximize what you have left over after paying taxes. And so a subtle difference, but really important, because we want to really have profitable farm businesses, and then after we pay taxes, have the most left over for ourselves. And so the first step, and really the basis, and what you really need to kind of worry about within your own operation, is the records and how to work with a tax professional. So that's what we're going to go over right now. So several organizations have record keeping requirements. Banks and lenders have some requirements. Farm Service Agency with USDA, Internal Revenue Service, the IRS, your state departments of revenue also have record keeping requirements. Insurance, to get crop insurance or property insurance. EPA may have some record keeping requirements. Department of Labor, FDA, USDA, if you're doing some other types of things, and then other state departments. So really kind of a host of people and a host of types of records that you can keep. And so we're not going to go into everything, but what I am going to go into today is a little bit more about the records that you need for tax purposes. But record keeping is a very important function of any farm or ranch business. It's important to keep track of your activities during the year. And not all the records that you keep are for tax purposes, but some of the records that you might be keeping are financial records, production records. What were your yields? When did you plant? When did you harvest? Any other information? You may have some food safety requirements, employee records, etc. And records are really the basis for all your financial records, the revenues and expenses. And a good practice that we really highly, highly, highly recommend is to have a separate bank account for your farm, separated from your personal, because you really need to keep those records as business records. And it really works much, much, much better and cleaner if we keep farm account records, and we also have all the cash going into a separate farm account. And then you also, with your records, want to reconcile the information in a timely manner, and then meet with your tax preparer during the year is also a really good practice. So one of the questions that I think gets asked a lot is for how long should I keep those records once I keep track of them? Generally, your tax period of limitations is 3 to 7 years. So after the event happens, you need to keep them for 3 to 7 years. If you haven't filed a tax return, or it's a fraudulent return, then that time period can go up indefinitely, and they can go back a lot further than that. With property or fixed assets, so fixed assets like your land, things that you're going to hold on to for a lot longer period, we want to keep those records for the life of that plus 3 additional years. So after you've either sold the land or gotten rid of it, or equipment or anything like that, you want to have those records from the time you purchased it until you dispose of it, and at least 3 years after that. And then some of your major items, you really want to keep those records indefinitely. And so have just kind of a separate place where you keep all of those. Employment records. The limitation is 4 years from when the tax was due or after the tax is paid. So whichever one of those is later, you need to keep them for at least 4 years. So that was really kind of what the periods of limitations are. Here's what we put in as just kind of good practices. If in doubt, go ahead and just keep it because we want to be able to go back to that if there's any doubt there. Financial records, keep them for a 7-year minimum. All records related to employees, even though that period of limitations was like 3 or 4 years after you paid the tax, really the best thing is to go back 10 years on that. And so keep those for 10 years. General ledger and financial statements, keep those indefinitely. Ownership information documents indefinitely. So ownership information documents, if you formed a partnership or an LLC or anything else like that, ownership of land, your titles, things like that, keep those. Business meetings, keep those indefinitely. Because that's really, if there's ever kind of a doubt on anything, that's what you kind of go back to. So, oh, I was just seeing just thing. So, and then deeds indefinitely, once a year, have a cleansing day. And so take some of your files and take them from kind of your short-term storage into more of a long-term storage. So clean everything out kind of once a year. Also, your electronic files, move those around so that you know kind of where you can go back to the older files, but you're not stumbling over everything all the time. And so just kind of, while it's still fresh within that year, it's a really good time to get clean those up. So these again are the good practices that we would recommend. So this is a quote from the South Carolina Department of Revenue, but most states have something very, very similar. And so, but I like the way that this one was stated. You need to really kind of keep such books or records are required to be kept at all times available for inspection by agents or auditors of the department and shall be retained for at least 4 years after the return was filed or due to be filed, whichever is later. So South Carolina is saying 4 years. The federal government is 7 years. But longer if there's some of these other things. So it's just kind of it just kind of sums up what types of records we want. And so the next kind of question that gets asked when we're looking at records is not only after we, kind of how long to keep them, but what do I really need to keep in my records with things? And there's a concept called constructive receipt. And constructive receipt just says we need to have enough information to answer these 3 questions. When did it occur? Where was it? And what was purchased or sold? So those are really the questions that we need to answer from your record keeping system with every transaction. So here's an example. On January 18th, we have a $1,200 charge from Co-op. So when I look at this example, do I know when did it occur? I do because it was January 18th in 2024. I know that it was from my co-op, and if there's only one co-op I deal with, then I know what co-op that was. And I probably know where it is. But what was purchased or sold? I have no information there because the co-op sells a variety of things. And so I really need more information. What do we need to know? And so I need to break that out into, in this case, it was 450 for fencing materials, 400 for irrigation supplies, and 350 for seeds and plants. And so once I add that other information to it and break it out, then I've really answered all those 3 and I have constructive receipt. I have the answers to all 3 of those questions. And I think if you just kind of remember these 3 questions as you're designing your record keeping system and just having in a way that you can pull this type of information back out of it. Record keeping options are manual, which you just write them down on a piece of paper or a tablet, some kind of ledger. We can also put them into an Excel workbook. So just kind of create your own. And again, what information you need to keep track of all those. You can also use the precept programs, QuickBooks is one of the most common and familiar. It doesn't always have all the ag accounts that are preloaded in there as options, but you can add different ones of those. And another one is PC Mars from Iowa State University. You can go to pcmars.com, and that one's more of a farm ag one. And there's others out there. These are just to give you kind of the general breadth of what types of options you have. If you only have a few things and you're starting out, it may be more manual or on Excel, and then you can go into some of these other programs as you go along. I've also seen people start out and do more manual when they're on the go. So where, even having a little, pocket notebook that's in like your truck or you carry with you. And so then as you make those transactions, you're not, where you can really kind of record everything. You can keep track of the receipts and jot down kind of what the information is there. So then you can go back home and record it into your record keeping system. So think about kind of what your record keeping system is. Here's some of the options, but then also have a good method for kind of keeping track of that information as you actually get it when you're on the go. Because I think a lot of times we're out running several errands. And so that's the time to kind of jot that down and then just come back and transcribe those into your, you can do it once a week, you can do it once a day, you know what I mean, kind of whatever works for you. And then once you have those records, you'll have to take them to a tax professional. And so what you're going to want with the tax professional is a summation of the current year's transactions based on the tax form line. And so on Schedule F for farming, and you can go to irs.gov and just search for a Schedule F, and you can pull a blank one up if you want to see what those line items are. And so you want to have a summation based upon that, because that's the lines that they're going to have to fill in on the tax return. And so normal reports from accounting software will give you all of that. If you have a manual one, then you'll need to kind of sum up those categories independently. So your feed separate from your fertilizer and some of those others. Capital assets and sales and purchases. So capital assets are your equipment, your machinery, land, buildings, any of that that you bought or sold during the year. You need to have the information related to that. So information on what you bought or sold, when you did it, and then some additional information on when, if it's something you sold, when did you originally acquire it, and the information related to that. 1099s are an informational form that the IRS uses, and it requires people to send some out for certain types of transactions, and you also may receive them for certain types of transactions. And if you send them out to somebody, one copy goes to the IRS and one copy goes to who you're sending it to. And then if you receive them, the same thing, you get one copy, but the IRS has also received a copy of the form that you received. So any 1099s that come, you want to keep track of those and take those with you to your tax professional. And they could be for things like interest that you paid or received, government program payments, FSA programs, EQIP from NRCS. There's maybe some others that you'll get. And then any end of year statements that you have, such as a financial institution for your debt or loans. And then any other income producing accounts, if you have any others, then you'll want the information on those. Forms are documents for employee transactions and changes through the year. So if you've hired any employees, if you've fired any employees, or any employees have left, anything like that, what you've paid your employees, anything that you've done there. And then end of year information on any insurance programs that you might be affecting what you're doing. So this is just kind of, again, a brief general overview. And then as you're working with the same tax professional, if that you establish more of a relationship from year to year, then they'll have some information from the previous year, and you'll also kind of develop a more working relationship on how they want to receive the information and how you provide it and stuff. But in general, this is what you would normally take to a tax professional. Another question, so that was our record keeping, and I'll show you some resources where you can go back and go through some of these topics in a bit more detail or at your own pace. But another question we have is it a farm? And so the tax definition of a farm is it includes livestock, dairy, poultry, fish, fur, fruit, and truck farms. Truck farms is another, it's a regional term for when people pulled their truck in and sold vegetables out of the back of their truck. So also, basically any vegetables and other things like that. It also includes plantations, ranches, ranges, orchards, and groves. So crop farms, cattle farms, truck farms, vegetable farms, orchards, vineyards, all of that is considered a farm from the tax definition. And so the IRS Publication 225, the Farmer's Tax Guide, defines a farmer or rancher as an individual in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. And so it's not just operating the farm, but also operating it as a profit. So if you're doing it as a hobby, then it's not a farm, but if you're doing it for profit, then it is a farm. And this definition also applies to partnerships, LLCs, corporations, estates, and trusts. You're not farming if you're providing agricultural operations as a service, so custom harvesting, custom farming, that's a business, but it's not considered a farm. And trucking of farm commodities to market wouldn't be a farm. And processing of commodities into something value added. So cheese, strawberry jam, cuts of meat, wine, all of those are value added activities because the farming operation is to the first sellable point. And so milk would be the first sellable point. Cheese would be something that we've done further processing. So the cheese is not a farming activity, but the producing the milk would be. Strawberry jam is not a farming activity, but producing the milk would be. Or I mean, producing the strawberries would be. So if you have something like this where you're doing something value added or some of these other things, you may have a need to actually have the records for that separate from your farm records. And so if you're like have a cheese operation and you're milking your cows or goats, you have a farm that milks cows and goats. You also have a business that makes cheese and sells cheese. And so the farming goat business would sell the milk to the cheese business. The cheese business would sell the cheese to the final customer. And so you'd have to break those out because they go on different forms within the IRS theme. However, if you're doing just a little bit of any of these activities as part of your overall farm operation, you don't need to separate it out. And so if I have my farming operation, but I use my farming equipment to cultivate one neighbor's field as that's custom farming, but I can still, it's just a small amount compared to my overall farming operations. So I can go ahead and include it with my farming operations. I'm using my farm equipment, I'm using my farm labor. The same thing with some of the further processing. If I'm mostly selling my like goat milk as milk, but I just make a little bit of cheese and it's a small part compared to what I'm doing overall, then I can go ahead and I don't have to separate it out into a separate business. And there's not any kind of formal rule on where that is. They just call it de minimis. So if it's a de minimis, a small amount, then you can go ahead and include it on your schedule F with your other farming activities. So records with value added. So like I said, you may have more than one business. So it's a good practice to keep some separate records and expenses and receipts needed to be separated if you have multiple businesses. And then you may be purchasing some of those ingredients from yourself. And so it's purchased from one business and goes into the other. But again, if it's a very small amount, you can still go ahead and include it with your farming operations. So that was like a brief overview. And then, let's see, I think I'm going backwards. Okay, there we go. Now we're here with some tax management. And again, I just want to kind of touch on some of these subjects and then tell you where you can go. So a basic part of any business management practice is not how to get out of paying taxes. That's going to come back to bite you because really it's not about getting out of paying taxes. It's just pushing them into the future and you're kind of snowballing this big tax liability. And there's some things that can happen with farming that causes that. So it's really about on how do I manage my taxes. So tax management is using available, I think, provisions within the Internal Revenue Code to get the most amount of income through the tax system at the smallest tax rate possible. And in order to do this, there's really, two big things that you need. You need to do pre-planning, and that's why you'd want to start working with a tax professional before the end of the tax year, ideally. And then you also have to have those records. You have to have a good set of records to know what's going on within your operation. And then and it's really kind of the final thing is to really understand that your accounting and record keeping and your tax management have this symbiotic relationship that you can't really do them separately. They really need to have, you have to have those good records in order to, and the pre-planning, and that's really where you get the best benefit. So how do you go about that? Build a team. One of the difference between farms that are economically and financially sustainable is that they're moving the farm producer from really just a producer that grows something to a farm business manager. And so we're really kind of thinking about that farm as our business and how do we manage it, and being able to properly manage all aspects of that business, and not just the production side, but also the business side. And this may require a good team. A lot of times we're not experts in everything. We can't be experts in everything. So your team may include the owner, the operator, manager, some key employees that are also working with you, a tax or legal professionals, financial advisor, extension agent, staff, faculty, like some of the stuff that Ramiro and Jan are providing you here today is part of that, and the other programs that they have. Crop insurance agents, your loan officer, lenders, so anybody else. So and then you should meet regularly with some of these people, you know what I mean? How input kind of what works for you? Where do you go for information? How do you bring that together? And what kind of services do you need? But just kind of, I think that finding and having a team like this doesn't just happen automatically. It's searching out, okay, I need certain information. I need certain types of help to help run my business. And so start asking people, who do you go to for tax help? You know what I mean? Where should I go for, you know what I mean? And just start kind of putting feelers out there if you don't already have a team assembled. And then some other tax management options, prepays. So if you're filing your tax return for a farm on a cash basis, which 99.9% of returns are done that way, then if you buy something in December for the following year, like you buy your fertilizer, some fuel in advance, or like your seed so that you lock in that price and also identify that that seed is yours and have availability, then you can actually deduct that in the year that you purchased it rather than waiting for the year that you used it. And that's what cash receipt. So that's what prepays are. And so decreases your tax in the year that you buy it because you have higher expenses, but it's going to not have that deduction in the next year. And so that's why you want to really kind of manage all of these things. There's a limitation on that to only 50% of your total deductible farm expenses for that one. Depreciation is another tax management tool. And this is how we take those long-term assets like tractors, other equipment, and how we write off a certain portion of those. There's some provisions to write it off the year you purchase it, heavy load some of the earlier years, or spread it out evenly. And so economic depreciation is how much the market value decreases. Tax depreciation is how you take it on your tax return. And that's what I was talking about. There's different provisions to write it off in the year that you purchase it, heavy load it in early years, or smooth it out over multiple years. So that's really just a decision to make with you and your tax professional on what makes the most sense for your operation. And then these are just some of those provisions, general depreciation, rapid or accelerated. And with tax depreciation, you want to be careful because using depreciation to offset taxes can cause longer term issues, because if you take all your deductions up front, but you're still paying for that asset, then you have to pay that with after-tax dollars and you have very few deductions. So it can actually lower tax in one year, but increase tax in another year. And so you really kind of want to think through multiple years as you're using those provisions. So some good practices. So here's your take homes. Find a tax preparer early, spring before farming. So right now is a great time to start looking for a tax professional for the following year. Meet in November, December for tax management. That's that before the end of the year to see some of those. In January, send out your 1099s and W-2s if you have to send those out to employees or other people that you might have to send out 1099s to. January and February, provide your records to your tax professional. March and April, they'll file that tax return. And so that kind of gives you what, just in good practices, how that calendar looks like and what you might be doing from a tax perspective throughout the year. Tax law changes. So these were the standard deductions for 2024. So you could make up to, this is what you could deduct, 14,600 for a single. Married filing jointly was 29,200. And then above that, up to the first 11,000 above that for individual or 23,000 for married filing jointly, you would pay a 10% tax rate. And then this is just the increments that go up, and it would go up to a 37% rate. And this is for the 2024 tax year. So the tax returns that you probably have been filing either already or will within the next month. Here's the 2025 one. So those numbers just changed slightly. So now we're at 15,000 and 30,000. So they went up a little bit for 2025 for that standard deduction. And then these brackets rates change a little bit. And just look for like 2024 tax brackets, 2025 tax brackets. And a lot of times you'll find these overall things. Tax law changes. So what we saw here in these two slides for 2024 and 2025 are just kind of the normal things just kind of get adjusted with inflation from year to year. And so those ones will change slightly from year to year. Tax law changes. We had a Tax Cut and Jobs Act of 2017 that had a lot of provisions and changes that went into the tax laws. Some of these, and especially ones for individual businesses, were scheduled to expire at the end of 2025. As of now, they're still scheduled to expire at the end of 2025. And these include provisions for like standard deductions, estate tax exemption, depreciation, a whole bunch of things. So what we're kind of on watch for over this next year is really just to see if new legislation is passed. We've probably all seen kind of in the news here and there where there's been some talk about it, but to this date, nothing has been passed, but there are real chances for these provisions to be extended past 2025, for new provisions to be put into place. So you want to just kind of keep your eye out for any of those new tax law changes. And so with that is the end of the presentation, but I was going to kind of quickly pull up the website. So this is ruraltax.org. Janet, can you see the ruraltax.org website, or do I need to quit sharing?
Yes. No, we do
Okay.
see it. Thank you.
All right, so here it is. And if you go here, you can kind of see some all tax topics, some disaster tax, new farmer tax information, grants and programs, tax management info. So some of the tax management info that I just went over here briefly, go to tax management and you'll see, in fact, I'll just click over there. So we've got some fact sheets here on managing income taxes after the end of the year, before the end of the year. And then if you scroll down, we've got links to the webinar recordings, so you can go through and just get more information on that. And if you want to just kind of poke around this website, you'll find some of the similar types of things. And so here you can go to all the tax topics that are there. Here's some collections at the top that'll kind of take you to some groupings, or you can just scroll down through. And there's a lot of different information. We talked about 1099s. And so Those are here, working with a tax professional. So a lot of just things here. So we went through stuff really, really, really quick. But I think starting with ruraltax.org is a great place to get some more information and go delve into some of these things in a little bit deeper way. So I'm going to stop my share screen there.
Great. Thank you
And
so much, Ruby. I know that was kind of a rushed presentation for you, but a lot of great information. Yeah, I'm glad we're
yeah, so I
recording
wanted
it.
to kind of give you an overview, but
Yeah,
to really kind of get it to settle, I would really encourage people to go back and kind of at their own pace, take some of those other
right,
topics in a little bit more detail.
right. No, we appreciate the resources. We are recording this webinar as well. Just to let everybody know, it will be a few weeks, but we will be getting that posted and we'll let you all know when all of the webinars of this series are available to access online. There are a couple of questions under the Q&A. Let's see. Maybe they've been asked. There's
So I think some of those were still Jeff's. What I see one
right.
for financial statements. Do you mean bank statements as part of what should be kept indefinitely? Yeah, I would go ahead and keep those. If you actually are compiling like a balance sheet or something from year to year, I would keep those. Some of your loan stuff that you're originating some of those loans and then paying them off just to show that you've paid them off. Some things like that. And is there any other questions that you wanted to answer, Jeff, or while you're,
Let me see. Yeah, there's a couple
oh
more.
yeah.
Would a plant nursery be considered a farm? In San Diego County, that's a large um, part of our agriculture industry is
Yeah, so if it's part of that, yeah, yes, a plant nursery would. Not if you're just buying it to resell it, but if you're growing it, then it is considered a farm.
okay. And then I think these top two from Darlene, I think are related to Jeff's talk. I don't know. Can you see those, Jeff? Or do you want me to read them too?
Oh, there we go.
Yeah, Q&A.
Let's see.
I think you were talking about corporations. So the question is, how does that work if the S corp has credit card debt? You mentioned the shareholders aren't liable for that. But in order for the company to get a credit card, don't they approve by looking at the credit card of those shareholders or the credit of those shareholders? So does the company have its own credit history afterwards? Once it's established?
Typically, that is true. If the credit card is taken out in the corporate name, it is a corporate credit card. Now, in some cases, I've seen the bank require the owners, especially in a small S corp, the bank would require, or credit card company would require the owners to personally be liable for the credit card debt. So in that case, they would be, because
Okay.
they've authorized that to happen.
Okay.
So that's one issue. Let's see.
Before we move on to the next question, I do want to just thank everyone for being here. If you start signing off and let you know that we do have an evaluation feedback survey link posted in the chat room. We really do appreciate your feedback and any comments you have. We're glad that you're here, but in order to keep our programming improving and continuing, we'd like to hear from you. So please take a minute. Just a couple quick questions there. So the next question I have is the one about one issue I've seen. Do you see these? I don't want to read them
I
if you can
do.
read them.
Yep, I
Okay,
do
I
see
won't
it.
read it.
And I would say, Darlene, that is a common issue because land is hard to find and to rent. So the landowner tends to be in the driver's seat in many cases. I would still, yes, you may need land. A producer may need the land very badly, but have an attorney look at it because you don't want to sign something that gets you into trouble down the road or jeopardizes the rest of your farming operation. So,
Okay. Just for the others, that was a question about land leasing and the challenges of having land access and having room to negotiate.
right.
So let me
And I
see.
think I answered the one question already on an LLC. It is not a
Right.
corporation. I also want to bring up, and I put in there, Ruby did a great job, but I want to emphasize that if you form an legal entity, that legal entity must have its own checking account.
Yeah.
You cannot commingle funds.
Right.
That would be, Jan, if
Mhm.
you just gave me your checking account number. Like,
Uh,
no, that's you can
right.
do that, but
Right.
that's not advisable.
Right.
Yeah, so just, talking about that, it's a legal requirement. If you have a separate legal entity, it has to have a separate checking account. So like an LLC or something, like a partnership or something. However, even if you don't have a separate legal entity and you're a sole proprietor, we still highly,
Yes.
highly, highly recommend having a separate checking account. Is
Right.
that a good summation, Jeff?
It is. I would add a few more.
Highlies.
Highly recommend. Almost, insist on.
Is that
Yeah.
a common issue that you see, a lack of separating, keeping financial records separate?
In the beginning, we see it more. So over
Okay.
time, but in the beginning, oh, I wanted to start this. I'm starting my farm, and they don't really always think about it as I need to set this up as a separate business. I need to, you know what I mean? Um,
Okay.
Especially in cases where the owners, the starter, those people starting up that farm business or any business have no business history.
Okay. Yeah. Yeah.
And so they don't even think
Great.
about it. The other problem we see is that you don't have the right account with you. And so you make purchases out of your personal account
Uh,
instead of, you know what I mean, the farm account. And, so some of those things, and you really want to avoid that if possible. There's a reason you have the separate account, so you want to treat them that way.
right. Okay.
Yeah. The one I saw getting in bad trouble with the accountant is the guy used his business checkbook, which was with a legal entity, and gave to the church
Oh.
as part of his normal tithing. And it's like,
Mm-hmm.
no, 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 you cannot do that.
Ah. Yeah.
But
All
those
right.
kind of things happen. Life
Mm-hmm.
goes on. We
Yeah.
get it figured out.
So I think though, I really thank you for allowing me to come here, and if there's other questions, let us know.
Yes.
But
Yep.
really, all this stuff, even though we went through really fast, there is really good information that you can go through at your own pace for all of the
Okay.
topics that I touched on.
Yep.
Well, we appreciate you both being here.
Yes, thank
As
you.
I chatted about in the beginning, this is part of our kind of deep dive into considerations and issues to think about or review with your business plan, understanding that business planning is a live process that you should, not only take time to create a business plan, but then review it and update it as needed to consider things such as your tax and legal, changes and laws and such. So, yeah, appreciate the recommendations for always checking with your professionals, your local professionals and your local ordinances and such and rules and things, but really great information, great resources. So thank you for joining us. If there's no other questions, I think we're going to go ahead and sign off for today. We appreciate you staying on a little bit longer.
Okay. Thank you. Appreciate
Okay.
it.
Thank
You
you.
bet.
Take care. Bye-bye.
Bye.